everything about the bottom works on your human emotions to make you lose more money. So that's why we have to be very self-aware of it, or else
Yeah.
you will definitely like lose money. Yeah.
Hi, everybody. Thanks for joining us. Now, today we're going to talk about all things stock market, and in particular, stock market psychology. Why do people manage to sell at the bottom of a stock market and then sort of spend the next few weeks sort of beating themselves up for selling at the wrong moment, and the whole psychology of the stock market? So I thought, who better to ask than somebody who is not only an analyst, a stock analyst, but somebody who has had the guts and courage to publish a prediction of when the bottom is going to be a day before the bottom, saying it's going to be the next day. And he did this on March the 20th, this year, the actual day before the recent major bottom. Now, most analysts, they call the stock market a week, the bottom, a week after it's bottomed, and they went, oh, that's the bottom. Well, that's not very helpful if you're panicking and selling shares. If somebody tells you the bottom is about to arrive and it's tomorrow, you're not going to panic sell, you're going to hang on. So that could change a few things. So let's have a bit of a chat about why do people sell at the bottom. And I'm very, very happy to introduce you to Kenneth Koh, who is the chief analyst and blogger at quantzombie.com. Hi, Kenneth. Welcome to the show.
Hey Tim, thanks for having me.
We have a show. So Quant Zombie, that's a weird name for an analyst. Why have you called it that?
Oh goodness, that's a good question. Okay, so there's a personal reason and there's a professional reason, I guess. So the reason why I call it Quant Zombie is because, well, let me tell you a little bit about my professional background first. Can I do that?
Okay, sure.
Okay,
Yeah,
so
please do.
so
Please.
so I started off my whole financial journey. Let me see, about 10 years ago, more than 12 years ago. So I started off as a full-time day trader. I would trade all sorts of price patterns, price setups. You call it technical trading, and I did it. I could make multiple trades a day. I could trade daily positions, weekly positions, anything with a price, I would trade it. So I did that for about 3 years. And that's when I started to get more interested in the whys, the why things happen as opposed to like what is happening. So in technical trading, trade lots of price patterns. We know certain patterns have a high probability of profitability if you trade it. But over time, I wanted to know why those patterns actually occur in the first place from a fundamental level. So that made me much more inquisitive about the market. So since then, I guess you can say I've been very obsessed with learning about the whys. So then I went on to pursue a CFA and then a CMT as well, in the hope of trying to understand all the nuances of the financial markets. After that, I was fortunate to be hired as a professional markets and equities analyst at a large broking firm. That was a great learning journey because in that company, I was tasked to basically give stock recommendations from a fundamental point of view. So that really was a different world, another way of looking at the world as opposed to the technical.
Yep.
And then, because in this company, I was like a jack of all trades, I also had to give market guidance. And that was the real learning journey. I had to work with the in-house economist, and together, as I looked to how different asset classes would react on a technical level and market sentiment, I worked with the economist and we tried to correlate our findings. And if we can agree on something, then we will say we think the market's going to do this for all these reasons. After that, I even had a chance to do some quantitative finance research. I was able to statistically test some of the hypotheses or things I was observing in the broad markets. Okay, anyway, that is my experience. So now I am presently taking a break professionally from the financial markets. I'm taking a year off because I'm writing a book about my personal journey. It's a Christian book. But along the way, I noticed that, this COVID crisis is causing a mini crash. It's coming. And I wasn't really I haven't blogged about anything for a few months actually. But then I started to see many, many signs that, I think a bottom is coming. And I know many of my friends were caught off guard. Like even the best investors, right? They had lost a lot. They were in despair. They were angry that they lost X amount of money and they were making bad decisions during the bottom. And here's where I had the most experience, because I study why markets make bottoms. And I know that at a market bottom, everything is set up against you as a human being to make you lose money. And unless you are self-aware of it, right, you're most likely going to make bad decisions. And it happens even to the best of people.
Interesting.
Okay. Yeah, that was a very long
So it's
intro.
the psychology at the bottom, because the bottom, it's almost like when somebody goes, I wish, I knew when the bottom of the market was, because then I could buy a bunch of stuff and it all goes up and everything's great. But it doesn't quite work like that when we're talking about the psychology of it, does it?
Yeah, because because the financial markets is an unknown entity. Like you can never be fully sure. It's not like math or physics where you can have an equation and verify your equation with empirical evidence. The stock markets is usually a reinforcement cycle. You have a thesis. If the market goes up, you just think your thesis is correct.
Yeah.
If you buy it, it goes down. All of a sudden, you start doubting your own thesis. It happens automatically. And then once you start doubting your own thesis,
it's true. It is absolutely true. When I wear red underpants, the market tends to go down that night. But when I wear blue underpants, it goes up. And that has always worked for me until it didn't.
Yeah, true. And then there are those that lose their pants altogether, right?
Yeah.
That's usually an indication that it went down for quite a while.
That's true. That's true. No underpants. Yeah. So, okay. So that's interesting. So that market psychology is, you still haven't told me about what quant zombie means.
Oh,
were you avoiding that?
Oh,
okay.
no, not avoiding. Okay. So here's the thing. So I realized, right, that okay. So on a technical level, when you're dealing with short-term signals, that usually can happen with how I say a lot of randomness, on a short term. But on the long term, like looking at bull markets and bear markets, there are usually reasons why certain patterns form, fundamental reasons, right? And I thought to myself, how can I find those things? What can I actually measure that can cut through the noise that will give me conviction where we are, as opposed to just reading the opinions of other people? Just because you read a brand name analyst like from Goldman Sachs or whatnot, right? I mean, actually their history of being not quite accurate is actually quite documented. So at the bottom, right, you're going to hear a lot of bad news. Everyone will be pushing their narrative with actual data points. The data points are not wrong, but everyone crafts their narrative based on how they see the data, right? And so you're getting so many narratives, you don't know who to believe. Yeah. And that causes you more panic, right? So I thought to myself, I need to find something that I can quantifiably measure to give me more conviction where we are in the market and whether it's a good time to buy. Hence, I like to look at quantitative measures, hence the quant, right?
Okay, so technical is where you're seeing patterns in the shape of the graph, and people are extrapolating lines to suggest that this is a support, this is a resistance, that sort of stuff. And so they're looking at the patterns. The fundamental is looking at the actual company's statistics and numbers, and the quantitative...
Not statistics. That's the interesting thing. It's not statistics. They're looking at numbers, economic numbers, profitability numbers. And they're trying to build a case from the ground up whether or not the company is going to be worth more in the future. It's not really statistical. Quantitative is statistical.
But it's what you might find in their prospectus or their AGM book or it's their balance sheet and cash flow and profit and loss and price earnings and all of this. Okay.
Yep.
So the technical guys are drawing lines and looking at trends on graphs. Yep. The fundamental guys are looking at the intrinsic value of an organization and its predictability for growth or decline going forward in the future. And the quantitative guys are looking at what?
Okay, so there is a disconnect between the three groups, and that's where my space is in. Okay, so the quant guys, right, basically do statistical study on any sort of strategy. The strategy could be based on fundamental matrices or technical matrices. But the point is that they want to see actual hard numbers. So for example, a technical guy might say, hey, every time if I trade a double bottom, right, I tend to make money. Okay, a quant guy is going to go, okay, let's test your claim. I'm going to try to program something that will look at 1,000 stocks in the last 10 years. What happens if I do that strategy? Then I start to see the behavior. Oh, if I do it for 5 years, I make X amount a year. If I do it for 10 years, I make less. And the good quant strategist will have to, okay, so a good quant strategist will see the performance and try to understand why is it the strategy works better on some times and not others.
Okay.
Then you would have explanatory power in your quant, right? Now, that's for technical. You can actually, they are also quant for fundamentals. So for example, you could have a thesis to say, for these type of stocks, let's say bank stocks, okay? Every time you hit a price to book value of less than 2, or less than 1, let's just say, if I buy it and I sell it every time it hits 1.5, what's my performance in the last 10 years? So that's what the quant guy would do. He tries to put actual numbers as to test what strategy that you have in mind, okay? But I'll tell you where the gaps are and why all three of them is harder to catch the bottom, okay? So the technical analyst looks at the price, but he cannot look inside the price. That's the thing. Meaning that, okay, we see price patterns, right? But do you know at that particular time who's buying, who's not buying, which type of people are buying? See, that actually tells you a lot of information if you can find it. So technical people don't quite do that. They're more interested in the actual price pattern itself. The fundamental people, right? In the end of the day, it's all about fundamentals. Let me just say that first, okay? It's all about fundamentals. But the problem with fundamentals is that it's such a giant field. There are so many variables. There are just so many variables that can affect what will happen into the future, right? And that's where some problems happen when certain fundamental analysts, right, are experts only in one point of view, and they forget. Like, so for example, I read a lot of, there's so much opinions out there, right? And when I see the bearish people who are on websites like Seeking Alpha or YouTube, these people have been in the market for over 10 years, and they give the reasons why. And they will say things like, oh my God, look at earnings. Retail earnings have dropped off so much. It's the same as the Great Depression. This is so bad. It's the same as the Great Depression. This, and this. Hence, all of them are calling for a lower bottom, right? Mm-hmm. But then I'm thinking to myself, but you're missing out some variables. How do you measure, for example, the impact of the QE, right? Mm-hmm. Because these are such big things impacting the economy in ways that it's just hard to figure out. The QE was
the Great Depression, the government wasn't pouring in the quantitative easing. They weren't pouring in massive amounts of money at that particular time like they're doing today. So that's a massive change variable.
Yeah, and the structural damage to the economy hasn't occurred yet. See, so these are actual differences. So you just can't compare based on certain things only. You have to factor a lot of things. So for example, this particular COVID crisis, right? The economy was in the US, was doing so well. Unemployment was at record lows. And what happened was we pulled a handbrake, right? I mean, that's a different story when you have asset bubbles that have already burst and you're in the midst of a recession. The recession hasn't quite occurred yet. It will likely happen, but it hasn't occurred yet. And then you had QE, and I think the Fed acted really quickly, actually. Like the moment they saw the potential damage, they jumped in.
Yeah.
And so these are extra variables that make it harder to predict fundamentals.
Yep. Fair enough.
Yeah.
Okay. Fair enough. So when you to tell us about picking the bottom, that sounds terrible.
Okay.
Yeah.
Okay. Maybe. Okay. So basically, picking the bottom occurs, right? Okay. If you look at it from a pure market psychology point of view, the bottom of the stock market doesn't occur when there is good news. And I think that's the one thing that people need to realize. Mm-hmm. In an ideal case, the bottom of the stock market occurs when most people who can sell their shares have already sold, which means the bad news, you can say, is almost at the maximum. That is where the bottom occurs. And that's the reason why the average investor always tends to miss the bottom by a lot, because they always wait for some good news, or at least some brand name analyst to say, oh, you know what, I think the bottom is in, before they actually feel comfortable to come in. But the problem is that those brand name analysts can tend to be late as well. Maybe
Because they've got a brand name that they don't want to lose, I suppose, by being wrong.
Yeah, exactly. I mean, because I had a small taste of it. I've never been as big as a Goldman Sachs analyst, right? I was in a local brokerage firm. But when I have to make a prediction on the market to say whether it's going up or down, oh, I'm just so afraid. I don't want to be wrong, right?
Yep.
So because if you're wrong, so many people are going to laugh at you. What you said is on public record. You can't take it back. So you want to just be extra conservative. You want to see like much more signs of good news before you actually say something. But the problem is at the bottom of the market, it comes when it's really, really bad news and the good news is slowly trickling in. Oh, so one more thing investors need to realize. At the bottom of the market in a crisis, the bad news is the loudest. The good news can only be found if you look under a rock, which is why you need to be able to know what to look for in a crisis bottom, or else you will never know it's a bottom. Maybe if I can show some slides, right, to explain
please do.
simple things that can help give a heuristic as to what I'm talking about. Is that okay?
Yeah,
all right,
sure.
So,
brilliant.
All right, cool. Just a few slides. So I'm going to put together some
I mean,
concepts.
the good news is there's lots of bad news around.
Good news. Okay, so bad news is bad, except when it's too. Bad news is bad, except when it is too extreme. See? Oh wait, let me share my screen first.
Yeah.
Share the screen. Here we go. All right, here we go. Okay, see my screen, right?
Yep.
Okay, so the key thing is this: bad news is bad. Bad news is bad until it hits the extreme, and that's why finding the bottom is so tricky. So the first concept I want to talk about, right, quickly, which I think is quite important for investors to know. I'm tailoring this for the average investor. Obviously, the average investor doesn't have time to read everything, right? So I just want to talk about some very broad strokes, which is very important to know. So what I'm showing you right now, right, is this is an idealized economic cycle. And I think it's important for people to know this first. So the black line that you see there, the sinusoidal wave that is lagged by 180 degrees if you're a math guy, shows not the stock price, but the economic cycle. If you're below the horizontal line, it means your economy is contracting, right? GDP is shrinking, unemployment is increasing. The bad news, basically. When you're above the line, the economy is in expansion. Okay. Now the green and red text you see there, bonds, stock, commodities, show you when those three asset classes, bonds, stocks, and commodities, tend to go up or tend to go down based on where you are in this business cycle. Okay. So if you look at stage one, right? Stage one, the economy is contracting. It is negative. That means you're getting unemployment, you're getting lower GDP, there's bad news ahead. At a certain point, as the economy is contracting, and at this point, both stocks and commodities are plunging. Does that sound familiar?
Yep. Yep.
It sounds familiar, right? You have a contraction of the economy, stocks and commodities are coming down. But then at a certain point, bonds start to go up. Now, the reason why bonds start to go up is because this is based on an idealized business cycle where the central banks will say, at a certain point, I want to juice up the economy. And so I'm going to add something to help the economy out. And what they do is they decrease interest rates. They might do QE. When that happens, right, that's when all of a sudden bonds start to go up. Okay. Now, at a certain point, as the bonds go up, and it makes liquidity easier to get, for all the businesses. Businesses can easily get loans, and even the loans that they get have such a low interest rate. So they have, I suppose, ammunition, to survive. At a certain point, the economy, of course, because of inertia, the economy still contracts, right? But at a certain point, business start to reinvest, and then the smart investors will go, you know what? Even though the economy is contracting, I can see that this will improve in 6 months' time. So they're forward-looking. And those will be the smart investors, and they'll start buying. So at stage two is when the very, very smart and quick investors have the foresight to know that maybe in 6 months' time, things will improve, and they are starting to buy at that point. So stage two is when stocks go up and bonds also go up. But here's the thing I want to note. At stage two, right, the economy is still in contraction. That's the key thing. So at the bottom, stocks go up, not when the economy is expanding, because that's when all the good news is coming, right? Stocks tend to go up when people are thinking, you know what, it's really not that bad. It's contracting, but it's not that bad. I expect it to get better 6 months later. Mm-hmm. And of course, stage three occurs when the rate of contraction decreases. Means that the economy is still contracting, it's just that more and more people are convinced that it won't be contracting soon. And stage three is usually when, between stage three and stage four is usually when the average investor jumps in. Because that's where essentially all the better news comes in. And stage two is where the stocks tend to bottom, but stage two is also where the news is the worst. You're at maximum contraction.
Okay.
So that's one thing.
In that graph, it says that stocks are going up in stage two. Are they really going up, or they're just?
Yeah. I mean, this is an idealized chart.
Okay.
So stage two is basically when the very, very smart and quickest of investors come in. Stage three is usually when the professional finance guys think it's not that bad. And between stage 3 and 4 is when the average investor comes in. So notice most of them miss out a big portion of the bottom. And by the way, I'm going to show statistics to show that this is actually true. This is actually true statistically. Right? Okay, so can I continue?
Yeah, so the mums and dads are coming in, or the average investor are coming in between stage 3 and 4 when pretty much the curve intersects the expansion contraction line. Yes. And they're coming in at that point because the news is now, everything in the news is like, we've got a booming economy, jobs are happening, everything's happening. They're going, good, let's invest.
Yes, but worst case is that they tend to sell at stage 2. I mean, I can tell you so many of my friends who I just talked to, right? Many of them actually sold at stage 2 and stage 1.
Yeah.
Because, I can't blame them because the news is really bad. I'm going to show, like, for example, Goldman Sachs? Goldman Sachs was, 1 week, I think, before I gave my alert that I think the bottom is coming, an intermediate bottom that can last for weeks. 1 week before that, Goldman Sachs was saying, this is really bad. I think the S&P will bottom at around 2,000. And that's actually much lower than where it was. Mm-hmm. Right? So, I mean, if you're a retail investor and you start to read big name guys like Goldman Sachs saying, this is really bad, it's probably going to go to 2,000. I mean, what you going to do, right?
If I was going to be cynical, they would say that so people will sell so they can buy.
Yeah, that's what you're supposed to. But that's the thing. You're right. It goes against your human nature to be self-aware and go, hold on a second. If Goldman Sachs is saying it, then I should wait 2 weeks because it takes 2 weeks for the retail investor to read what Goldman Sachs says and act on it. And at that point, wait, did everybody who could have sold, have they already sold? And if so, how much lower could it go? Right?
That's true. So, and you know what? At this point, I think I need to do something. I need to just say a giant disclaimer. And the disclaimer is, pretend that everything we say on this show is completely made up. And don't use any of this to make any financial decisions and blame us. Okay, I think that's the easiest way to say the disclaimer.
Yeah,
this is
for educational purposes only, and it helps.
Yeah.
I'm doing this to help people be self-aware of market psychology. Okay, I'm not trying to say whether you should be buying now or not. Okay.
Yeah, and we got nothing against Goldman Sachs.
Yeah. I mean, nothing wrong with Goldman Sachs. Okay, I mean, even the best of them have good calls and bad calls. You know what I mean, right? But we have to be aware that it's like that, no matter who you are, there are good calls and bad calls,
Yeah, so pretend, well, maybe now's a good time to flash a disclaimer on the screen and done. Okay, good. Okay, so we're at stage 3 has just happened. So now we're moving into what? Stage 4, presumably.
Yeah. Well, no, I can't say that. See, that's the thing. So ideal probability.
No, on your chart, on your chart.
Oh, right. I think, the rest is self-explanatory, right? I mean, so basically when the economy is booming, right, that's when stocks continue to go up. And also this chart tells you one thing. The top of the stock market doesn't occur when there's a lot of bad news either. Stage 5 shows you that the top of the stock market occurs actually at the height of economic expansion. Interestingly enough, it's when the news is so great that people think that the economy is bulletproof and everyone is so confident. And when everyone's so confident, and when your mom and your pops are just so happy because they invested in stocks and they made a lot of money, and your taxi driver comes and says, "Hey, I got a stock tip for you," then that's when you got to think to yourself, wow, did everybody who could have bought stocks already have bought stocks? And if so, how much more can it go up? I mean, that's a legitimate question to ask, right? Yeah,
so when you say that, let me just jump on that, because you said the bottom happens when whoever can sell has already sold.
yes.
Who's the whoever you're talking about? You're talking about the smart people, or you're talking about the average investor?
That's a good point. So when I say, I mean majority. Okay, majority. So I mean, a one heuristic that you can use is you can divide the market into a few categories. Just to make it easy for me, I divide it this way. You have business insiders, smart money, and dumb money. So and smart and dumb money has nothing to do with how smart or dumb you actually are in terms of IQ. Nothing to do with that. The insiders are people who are actual specialists when it comes to the business that they operate. So when you see a CEO or a CFO that's been working in this sector for the last 10, 20 years, he will be what I consider a true business specialist, right? They're the top of the food chain. They have the best idea of how the fundamentals will affect their company, and they are the best people to calculate how much their stock is worth. You know, anyone on the outside will not be able to do as good a job, right? Okay.
So he or she understands the numbers of their business super personally, and if they're buying their own shares, they know it's at a good value price. And if they're selling their own shares, they know that there's a challenge coming.
Yeah.
Or they expect it. Yeah.
Yeah, these guys can be wrong. They historically they have been wrong at times. It's just that they tend to be right most of the time. So they're the best people to trust, even though they're fallible.
Yep.
Then you have a range of what I call smarter money, and those are the people who are professional finance people who every day they spend their time researching into the market, and analysts that interviews all these CEOs as their day job. So these people will have a more of an insight of the market, and I consider after that, the last category, the retail people. Retail people follow the advice of the second group and are usually the last to get into the action.
Okay, fair enough.
Yep. And so I'm saying that the bottom of the market occurs when the second and third group are bearish. When most of the second group and the third group are bearish, you have a chance for there to be a market bottom.
But the insiders have already got out, so they're just...
If they come back in, yes. So here's the thing. When all three are bearish, when the insiders, the smart money and dumb money are bearish, you're in the middle of the bear market. But the bottom of the bear market occurs when the top categories start to become less bearish.
Fair enough.
And the last two categories are still very bearish. So for example, when I first suggested the idea, hey, I think a bottom could happen, we should discuss it. I had some rich tycoons who've been investing for the last 10 years. They have fund managers reporting to them. And when I just broached the question, hey, should we discuss if there's a bottom? The automatic response I got was, there's no need to discuss. It's definitely not bottom. And I thought to myself, wow, you're so confident it's not bottom. That's what I was thinking to myself.
Yeah.
And if you're so confident it's not a bottom, maybe it is bottom. So it made me want to investigate it even more. So can I continue on my slide?
Very contrarian. Yeah.
Very contrarian.
Okay.
Yeah. Can I continue?
Sure, please.
All right. So here's a chart that's quite prescriptive. It just shows the emotional state of people during up and down markets. So the part I want to focus on is just the bottom part here. Okay, so from the top of the market, euphoria, as you come down, these are the different types of emotions that most people are going to have. Right? You go from euphoria, as it comes down a little bit, People are complacent because the bull market was so strong. Everyone thinks they recover. All of a sudden, it doesn't recover. People get anxious. Then it goes on even more. You get denial. At the bottom, what do you get? You get panic. Oh no, everyone is panicking. I don't care anymore. I'm just going to sell it. I don't care. I just don't care. And at the bottom, you get anger, right? Because at the bottom, it's going to be very whippy. You tried to buy, it didn't go up. You lost more money, you get angry. And I can tell you something, in the mini crash that we had, I actually saw a lot of panic and anger in many people. So the bottom of the market occurs, as the price goes down, people get more emotionally angry and afraid. And that makes you as a human being want to sell out even more and not look at this market again. That's why the market bottoms are so dangerous, because it just has a tendency to make you make rash decisions because of your emotional state.
It's herd mentality, but from a psychology of panic perspective.
Well, the herd doesn't help, right? So the herd is a self-reinforcing mechanism. It augments what you see here. So if some people are panicking, more people are going to panic. And if some people are in anger, more people are in anger. Because you just have to look at, go to Seeking Alpha. And as the price goes down and down and down, you can see all the headlines becoming more negative. Yeah, we're never going to recover. Oh my goodness, this company is doomed. And you see so much of it, right? I mean, if I'm a retail investor, just one look at it, I'll become more negative, right? Okay, but I'm going to show you something interesting, right? But here's the thing. Investors that sell at the bottom, right? They don't just suffer from what I call emotional discipline. That's unfair. It's not like people are dumb and people can't manage their emotions. That's why they sell at the bottom, because there are actually things going against you. And I'm going to show you why I say that. Okay, so let me go to the next slide, right? Oops. This is very interesting. This is what I was talking about. Notice here, Goldman Sachs warns S&P 500 might not bottom until 2000. Right? He said that March 16th, which is right over here. The price was about 2,400, and they're saying that the price is going to come down another 15-20%. So if you're an investor and you've already lost 30%, you're not willing to lose another 20%, right? So you're going to sell. But guess what? Look what happened at April 13th. April 13th is like what? 1.5 weeks ago? 2 weeks ago? Goldman Sachs abandons its bearish near-term view on stocks, says the bottom is in. Wow. So this whole move here was missed out by Goldman Sachs, right? And now, if you're a retail investor or an average investor, you are going to read reports like Goldman Sachs. And don't forget, average investors, when they read the report, they don't read it straight away. Just because you read the report today doesn't mean you're going to sell your shares straight away, right? There's a lag. You will probably react to it a couple of days later. So if that happened, what will happen to you? You're not going to sell it here at this level here, right? You're going to sell it further down, right? Aren't you? And when you buy it, you're not going to buy it here, right? You're going to buy up here, right? So what happens is that there's statistical evidence to show that the average investor tends to be very late coming back into crisis markets. And that's why they don't outperform like the broad market, because they tend to sell a bit late and they tend to buy back in even later than that. And knowing this helps us to have the self-awareness to know what we should be doing during crisis bottoms. If you didn't know this, it's much harder to make rational decisions. So there was a research by Delbar. Oh, by the way, since we're on this topic, right, I just want to let people know, right, I didn't post a blog for months. And my first blog that I posted, I basically said that an intermediate bottom might be in the process. And I even defined it as stability for a few weeks. And this was the date that I posted it at, the day before the actual bottom itself. Nice. And I'm just comparing this to Goldman Sachs' call over here. I'm not saying I'm better than Goldman, okay? So if you're Goldman, don't come after me.
But they lost. They missed out, or people following their advice basically missed out on a massive turnaround. They would have effectively sold low and bought high, which is the opposite of what we want to do.
Correct. I mean, and and for the stocks that I even listed out, so I'm not, okay, for those watching right now, I'm not saying you should buy these stocks. Most of them have already risen, by the way. They've already risen by between 20 and 60% already. I'm not saying you should get it onto it now. I'm just saying that these are the stocks that I mentioned, right? And my thesis was quite...
Yep.
Yeah, my thesis was like this. I said that I'm not sure if the stock market can go back to its highs. I didn't say that. I said that basically I think that a bottom is in the making. And if there's a bottom in the making, it means that all the stocks that are trading at bankruptcy prices probably can recover to significant levels, to more respectable levels first. That was my thesis, and I picked the ones that were bombed out. Okay, anyway.
Okay, so is this a fair question? How did you know?
Good question. Good question. So here's the thing, right? At the bottom, there is great uncertainty. And that's the reason why, if you're a professional analyst, right, you're hesitant to call a bottom, because there's great uncertainty. At that point, there were so many models on the COVID, right? There were so many models. You don't even know when the inflection point is going to occur in terms of, right, how the infection is decreasing. You don't really know which companies can't get access to loans and things like that, right? There's so many things you don't know. That's why I don't blame analysts for waiting longer before you say maybe a bottom is in.
Yep.
So I did it in two ways. You see, here's the heuristic that I use. And I only use this heuristic at the bottom. If you're not at the bottom, you probably shouldn't use this. If you're not at the bottom and the economy is working more normally, you would probably want to listen to Goldman Sachs and all these people, actually, because they're much better at the fundamentals, right? So what I did was...
Are you saying you're only good, you're really good at bottoms and that's about it?
No one cares about me when it's not a bottom. And I expect when the bottom is over, I'll disappear and everybody will keep listening to all the fundamental analysts and the Goldman Sachs and the Seeking Alpha writers and all that. I only came out because...
When you pop your head up again, there's another bottom coming.
Because if you can time the market in a crisis, right? I mean, that's when you can get 3x, 4x. It will set you up for a long time. And that's the only reason why I came out this time, because I just felt that my voice is needed now.
Yep.
I think in 9 months' time, and when I wrote my blog, it was more for my friends. Because everyone was calling me, those who know me, and asking for advice. They didn't know what to do. They're depressed because they sold and everything, and they lost 30, 40, 50%. And so I thought, oh my goodness, everyone is panicking. It's my Christian duty to help my friends. Okay, I'm going to say it. And I didn't want to write the blog because when you write a blog, you can be wrong, right? And what if you're wrong? What if I call it a bottom and it goes further down? Then I don't want to cause people to lose even more money because of me. You know what I mean?
Yeah.
So I had to really think about it and go, if this is my truly honest perspective, then I have to say something, because I cut my teeth in 2009. When I started trading, it was at 2007, 2009. So I went through the financial crisis. So I had experience actually navigating the bottom and catching the bottom. So at the very least, I should tell people what I did last time in 2009 to find the bottom. And so far, it worked out pretty well, I must say. Like, it's pretty well. So what I looked for was... instead of looking at fundamentals, because the fundamentals are too unclear, the first thing you need to do is go, I need to have at the very least, you must have some reason why the market will recover. So you do need fundamentals, okay? And my thesis was, I don't think COVID is as bad as people think. I mean, that's what I sincerely believe, but of course, I'm not sure. Second, historic QE. That was two reasons why. Because don't forget, remember I showed you that economic cycle chart, right? Bonds must go up first. Then stocks will go up later on, but it's just that you don't know how long, right? But at least I got the first stage in. Before the Fed stepped in, I wouldn't even dare. You know what I mean, right? But because they stepped in, I go, oh, they stepping in, giving historic QE gives me the permission to believe that stocks can go up, but I just don't know when. That's all. Then the second thing is I just don't think COVID was as bad as people thought, because I saw many people giving theoretical models. I had my friends who are not medically trained, who are not even engineering trained. They were people working at Google who are programmers, and they were just using models to predict how bad it's going to be. And the predictions was really, really, really bad. Okay, really bad. But then here's where you got to think out the box. The only way to outperform the market is to have a thesis that is different from other people. And my thesis was, these people are using those models, right? But I know how those models work. They work on exponential predictions based on constants that you use, right? And I know the constants they're using is based on countries that already had COVID. But I realized one thing: those death numbers, right, are probably overstated. And this was my thesis because one, you don't know how many people actually have the infection. You know what I mean? You only know people who are tested. So the infection numbers are probably much bigger than reported. And the death numbers, right, are probably less than reported.
Of that. Okay.
Yes, the death numbers are probably less as well because I was reading different countries and realized that hospitals will report death by COVID-19 even if it might not have been COVID-19. For example, if the guy is dying of cancer for the last 9 months and he died of complications, it could be an assumption he died of COVID. It's reported as COVID. So the death numbers are probably less than expected, and the infection numbers are more than expected. So maybe it's not as bad as we think, right? So that's the first thing. But of course,
even if the death number is absolutely accurate, the numbers who probably have it but have not been tested are probably far greater.
Exactly. So the actual death rate is less, right?
Yeah.
Okay. So
percentage. Yeah.
Yeah, and at the same time, I also think that it's hard for models to factor in the effect of things like social distancing. I mean, how do you model that, right?
Yeah.
You can't. So all this tells me there's a great uncertainty to this. It's not a fixed science per se. But then of course you need. So once I feel that, okay, I think yes, I have permission to believe that at some point the markets will recover. Okay, then the next thing you do is you measure the fear in the market. That's why I say quant zombie, right? You have to measure something. And just a tip here, I measured it by looking at the VIX. Okay, the VIX tells you basically just how panicky the whole market is, the entire market as an average. I don't want to go into the details.
So can you explain what the VIX is for somebody who might not know?
Volatility index. Okay, basically, okay, I'll give the simplified definition. Okay, so don't quote me on this, but essentially the VIX measures how much more premium traders are willing to pay for stock options on the S&P 500. So basically, the more premium you're willing to pay on the option tells you just how much afraid you are for future volatility. Okay, so it's something you can actually measure. You see what I mean? Like, you can't measure narratives out there. You can't measure opinions, but you can measure that's measurable.
Yep.
And I found that hey, the last time you had a VIX number so great, it was back in 2009 at the financial crisis. The last time the VIX was that great was when the financial crisis started its bottoming process. Right? So that tells me, oh, there we go. That tells me that most people that have already sold have probably sold. Or rather, maybe at best you can say, I think we are closer to the bottom than the top. I can say that. I think that's a very fair statement based on the VIX.
Or the bad news is the noisiest, like you said. The good news is under a rock. And if the bad news is the noisiest, the uncertainty is the greatest, the higher the premium they'll pay for effectively the insurance, which is the option.
Yeah. And you see what I mean by good news under a rock? See, the bad news is everywhere. COVID deaths, COVID infection, economy might crash. You look at all the reports in Seeking Alpha and all that, majority is bearish, right? But do you see anyone saying, hey guys, look at the VIX, it's the same level as the financial crisis? Like, for every one article like that, you probably find 50 other bearish articles that say the fundamentals are really bad, right? Yeah. And there are many things that can spook an investor. I'm going to show you another. Let me show you another one. Okay, this is one. Okay, what I'm showing you right now is this is. So this is one well-known used heuristic that shows like the ideal stock market bull and bear over here. Mm-hmm. And one writer basically was a fundamental guy who was very, very bearish. And by the way, this is very recent. This was like just last week. He basically gave a whole lot of fundamental reasons saying how bad things are, unemployment, yada, 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 and then put a chart like this. But do you see what he's saying? He's basically saying, look at in terms of the price chart alone, this first move here looks as though it's like this. See? So he's expecting Armageddon, right? Now, this is what I mean by people might have, will create narratives based on what they know. And I'm not saying that this is wrong. I'm saying that it's missing out certain elements that you will not know unless you might investigate things. So even though it looks like every bear market looks like it's going to come down like this, but yet, if you look at this chart itself, this measures the emotional state of mind, right, of people. My argument is that all these stages occurred already over here. Right? He's saying that, oh, we're only at here. Denial, bull trap. See, the fear, capitulation, and despair hasn't occurred yet. I argue that's not true because there were a few companies on the S&P 500. There were a few companies in the US market. They were already trading at bankruptcy levels.
Yep.
That is not fear. That is capitulation.
Well, can we put it in? Yeah, can we put it in perspective? The drop from that peak to that bottom, I suppose, happened. In the S&P 500. The drop from the peak to what looks like that bottom, how fast was that compared to 2009?
Yeah, so, oh, you mean this one here?
Yeah.
The recent, yeah, it's only like 1.5 months.
And 2009, right? How long did it take for that drop to happen?
1.5 years.
So, for that same level of drop?
This
is just happening much faster.
Oh, I see. This drop here is 35%. This drop, the recent drop is 35%. This drop from here to the 2009 one was about 55%. That's because they went into a full-blown actual bear market, like a real bear market that was compounded by a financial crisis. Right? But over here, the point that I was making is that we don't know whether the bear market is going to occur yet. Right? The variance of what might happen is so wide because the bear market will only happen if there's structural damage that might lead to some financial crisis. You know what I mean? If there are many companies that go bankrupt and makes banks freeze, okay, that might cause a big dislocation in the market. Then I will say this happened, right? But we don't know that yet. And the Fed stepped in really quickly. And the QE is historic. It is not a small bazooka. Someone said it's more like a neutron bomb. And they were even buying all sorts of business loans, even the less than, like the lower grade loans. They were really trying to support many businesses out there for 3 months. So there is a thesis that, hey, they might stop some sort of structural damage. You know what I mean? Yeah, you have a sharp recession, right? But there's a chance that they might save the economy in the sense that there's no structural damage. So since we don't know that yet, right, we can't conclude this, right? But what you can conclude is that in this thing over here, the investors already went through the entire cycle.
Correct.
Of the bear market. That's the thing. It was all compressed in that 35% drop. You had, because the VIX levels were the same as the crisis levels of 2009. That was the last time it was so high. So I made the conclusion that that's a mini crash. Until the fundamentals prove that we are in a bear market, we are probably massively oversold. So my thesis was that I don't know how things are going to go in the future. I just think that we are massively oversold and there was forced selling and capitulation even before the fundamentals came in. And I saw the VIX levels so high, tells me that many people who have sold already. And of course, then I trying to prove my thesis, right? I call my friends. And what you got to do is you got to call friends who are like doing different things and see what they say. So I had friends who are day traders. They try to trade technically and they all sold at the bottom. I had people who were in the business for 5-6 years who were stock pickers, and even they were bearish. They didn't dare to come in. Everybody that I called didn't dare to come in. So I was like, but if all these people didn't dare to come in, then who's left? Right? So I mean, but that's just anecdotal evidence that kind of corroborated the VIX theory, right? So the second thing you need to do is this. So you know that the market is massively oversold. Any glimmer of hope, right, is going to make the market increase. So that's where, you know, the investigative science comes in. You need to figure out who are the real know the economy the best and see what they're doing. But these people are quiet. That's the thing. You won't find them on the headlines. And when you do, you start to realize, oh my goodness, the average investor is selling, the professionals are bearish. Hey, but the people that really know the economy the best, hey, they're starting to, they're not behaving as though it is, it's a financial crisis. And then when you see enough of that and you realize the extreme levels of these numbers, that's when you can say that there's a high probability that this is like a bottom.
And those people are the insiders, are they?
People like that. Yeah,
people like
that.
Okay.
People like that. And of course, you want to try to find things that you can measure, right? Not just opinions, right? And you can find things like fund flows and things like that, and see where their money is going. So so this is just theoretical, right? When everyone has panicked and is in despair, you're ripe for some reversal to happen. But you just need to make sure that you're on the same side as the smartest of all the people. And if you are, then what I can say is that even though that might not be the bottom, but the probability that that's a bottom is much higher. So you have to try. So what you have to do and the thing is, when I started to nibble at that bottom, it was not easy. See, even for myself, when I see all those numbers, like the numbers are telling me to go in, but the bad news is so bad. Right? Yeah. And then, and Goldman Sachs is saying it's going to go even further down. And I have to challenge myself, wait, does Goldman know something I don't know? And it's so hard. So I had to hold my nose and go, okay, hold my nose and buy some, right? And that's how difficult it is.
What percentage of your cash that's available for investing would you put in at that point? You're not going to go all in, presumably.
Okay, so this was my thesis, okay? And please, whatever I say, I'm just a dumbass, talking to you from Perth. I'm not from Goldman Sachs. No one cares about me, all right? No one cares about me. I'm just a guy that's just talking on my ass.
Yeah, this is Kenneth and I down the pub.
Yeah,
so ignore everything he says.
Okay, so this was my thesis, right? Yeah. And this has worked really well for me. Okay, now, at the bottom, right? If you buy at the bottom, you must be confident to hold it. You have to. You cannot have I'll buy it here and hope it goes up. If it doesn't, I'll cut. You can't do that because the bottom is very volatile. If you do that, you'll end up losing more money. I can guarantee it. So to safeguard myself, this is how I looked at it. I saw 2009. I said the VIX levels tells me that the bottoming process is in. I know it's in. I just don't know how long it'll take to bottom. That's all. But it's in. And I'm much closer to the bottom than the top. That I know, right? So I said, okay, so I think that even if the economy takes a while and it bottoms even more, I didn't think the next bottom will be that much lower than this bottom. By this time, we lost 35%, of S&P. But some stocks out there were trading at 75, 80%. You see what I'm getting at? I mean, if those stocks are trading at 80% down, how much more lower can it go? 10% more? Okay, 90%, right? So I told myself, okay, so since I know that we're almost at the bottom, and this is a bottom, but I just don't know whether it's the final bottom. I don't know that. Okay, I must put in money now, but how much? So what I did was I gave a guide like, okay, based on how comfortable you are and your calculations, I said, okay, maybe I put in 70% of my cash now, or maybe 75%, and 25% I'll keep it just in case we reach a lower bottom. Now, to do such things, right, you do need to know what you're buying. You have to do your due diligence what you're buying, and you need to have an expectation of how things will be in the future, right? So a rough gauge is you can see something like this. Okay, this stock trades at this price right now. When things are healthy, it trades at this price. Okay, so you make a comparison. And I told myself this, you know what? Let's say it takes 3-4 years before the economy recovers to something close to what it is now. So I know roughly what I can get, right? It'll take me 4 or 5 years to get to that price. And then I tell myself, okay, if that happens, what's my yearly gain? And I go, oh, if I do this, if it goes up by 90% in those years, I'll make 20% a year, basically, right? Am I happy with that? Yes, I'm happy with that. Okay. But if it goes down further, if I have some cash, I can put it in when it's even lower. And in both scenarios, of whether it goes up and never comes back, and whether it makes a lower bottom, I have to be happy with my decision making. You know what I mean? You have to entertain both possibilities that this bottom is the final bottom and it won't go back here, or or that the bottom, there's another bottom, but maybe it won't be that much lower.
So that's interesting. I was going to say that's fantastic advice, but I don't want to call it advice. I just want to say it's a really nice perspective. The what would you say to somebody who's 75 years old, they've retired, they don't have an income other than what's in the stock market? And I don't know where they are now with regards to panic selling and everything else. But what would you say to them where their income came from either dividends or selling off shares bits at a time to provide for themselves and their family? What would you say to them? Let's say that they've sold a bunch already and they're beating themselves up, but they've got some cash because they sold.
Oh, yeah. So, I mean, okay, so right now, the fund, I will say right now, most investors have missed the juiciest part of the recovery, right? So they lost the premium between panic and no panic. Now we're actually, contrary to what people think, right? We're not that optimistic now. See, so I measure these things. Some people are, when you read Seeking Alpha, some people are incredulous, saying, how can people be so bullish, right? But actually, if you look at actual measurements, we are not actually very that overjoyed. And many people haven't exactly got back in yet. But anyway, that's not the point. So the first piece of advice I'll say is this. Whether you're an investor or a trader, right, you have to completely forget what you have lost first. Because if you keep thinking about, oh, I lost 50%, I must make it back, right? We tend to make worse decisions. So we should start our thinking afresh again. That's the first thing you need to do. The second thing you need to do is, because it's a bottom and the COVID is a very uncertain animal, this whole crisis thing, right? You really do need to do a lot of work to bury yourself in the fundamentals of a company. Like you have to, because if you don't, right, and you're not convinced about a certain company, you will tend to not be able to sleep at night, and you will not be able to size your position properly. So I'll give an example, right? So I might say that a company X, because of its absolute valuation, that the company X has so much cash on its books and that it has never turned a loss ever, even during 2009, I can peg like a low level of what might happen. Say, even in the worst case scenario, this is what's going to happen. Then I say, if that's what's going to happen, I know they're going to give me a dividend. And if I buy at this price, that dividend is going to be 4.5%, 5%. And then you tell yourself, if that's the worst case scenario, can I live with that? And then you size your bet accordingly. So I would look at the fundamentals, assume a bad case, so assume it's going to react the same way it did in the financial crisis, for example, and then ask yourself whether you're happy with the cash flow that it throws off or the dividends that it throws off, and then you invest like that. That's one example.
Fair enough. So step one, be kind to yourself, let it go, stop beating yourself up. Because then I guess if you're beating yourself up and you've got the mindset of wanting to make it back, you're gonna make leveraged all-in decisions.
Yes.
For a movement to try and gamble your way out of it.
Yeah. I know professional investors, right? When I say professional, I mean, even if they're not working in an institution, but they invest for a living.
Yep.
These people are so married to their pride. They say like, every year I make 20% a year. Today I'm down 50, right? And they feel that, okay, now I must make it all back. If I get the right stock, the most bombed out stock, right, I can maybe make it all back. And then they over leverage. They put in 100% in again. And the problem is that once your size is too big, you're emotional. That's the problem. So the moment the price turns down, straight away he's thinking, oh no, am I wrong? Am I wrong? Am I wrong? And then it goes down 5-10%. They sell it again. They get angry with themselves. And then tomorrow it goes up by 20%. It happens like that. That's why you can't tell yourself to make it all back at once, but you just have to tell yourself, if I could start anew today, like if today I came into the market for the first time,
Yep.
and I have this much money. What will I do with it? How would I plan for the future, right? I mean, that's
Yep.
what you got to do. You've got to forget all the bad stuff that happened, all the bad trading decisions you made, and the losses that you had.
So, for want of a better description, this is possibly a terrible description, but if we're playing a card game, you and me, and
Mm-hmm.
I just lost that last hand, and then we shuffle the deck and deal again, I'm
Yep.
playing a brand new game. I can learn from that last hand, but
Yep.
I'll start with what I have in my hand, which presumably is what you've already got. Now, of course, somebody watching this might be getting emotional, going, "Yeah, but this is not a card game. This is my life. This is my retirement. This is my this. This is my that." Which means presumably they're still in the anger stage of the curve that you
Yep.
were showing, and it's to almost
Yep.
go back and look at that curve again to just understand that this is very natural. But the faster
Yep.
we get out of it, the faster we can start making logical decisions and not emotional ones.
Yeah, and actually, your explanation analogy of a card game is very apt. For example, if you're playing poker, you have a strategy, right? And you use your strategy on that hand, and let's say it didn't work, you lost some money, right? Here's the thing: if you are confident in your strategy, right, you would do it again.
Yep.
You are not supposed to stop doing it just because you lose one or two hands. That's the thing.
Yep.
If you are scared of using the same strategy after losing one or two hands, it means you probably did not research your strategy well enough.
Yep.
So I'll give you an example. So there was one stock which I studied really, really hard. Like I really studied hard it for like weeks and months, right? And I was so convinced that the value of this thing has to be at least 60 cents a share. I was so convinced. Even in a financial crisis, it's worth 60 cents. I was so convinced, right? But then what happened was this: it sold down even less than that. It went down to 50, even to a low of 46. Now, at that point in time, I was really afraid. I was like, wait, am I wrong here? Like, this is, what am I missing, right? And yes, every instinct inside of me was saying, you know what, I should just sell and get out. But what I did was instead was, no, let me redouble this. Let me rethink about this. So I studied it again and I go, no, I just see that the worst case scenario can't be that bad. It just can't be. And it's worth so much more. And at that time, the dividend yield was going to be about 10% plus. And this company is a net cash company, means that it has zero debt, which means they would definitely pay it out and everything. And I thought to myself, at that point, I did the unthinkable, right? I held my nose and I actually bought some more at 46. And that time, my cash levels were almost maxed out. I only had a little bit left. So that little bit left, I threw it back in. And the funny thing was like, there was actually a professional analyst, right, that said that this thing is not worth 60 cents. It was worth 50 cents. So that made me even more like afraid. Oh, am I wrong here? But I held
Yep.
my nose and about it. And I reiterated on my blog, it's worth 60 cents at least. And well, fast forward like 2 weeks, 3 weeks, right? I mean, it's actually back at 62 right now. We went past. So the point is that if you are afraid and you're making bad decisions and you're not sure what to do, it means probably one of two things. It means one, either you haven't researched the fundamentals of what you're investing in well enough, and you really should. Because if you don't, you can't sleep at night. Or two, your position sizing is too big. It's usually one of the two, meaning you put too much money into that stock, much more than you're willing to lose. Yeah. So I would say reconsider those two things. Learn about what you're doing more, like really take the opportunity to study it from different angles, and two, to change your risk management if you think there's too much.
Interesting.
Does that help?
Yeah. Well, I hope so. But yes, thank
Well,
you.
because if you don't know the company, that's the difference between selling at a loss and buying more at a cheaper price.
Yeah. True.
Yeah.
Yep. I mean, in other words, you're saying you have to have a thesis for holding.
Yes, exactly.
Because if you don't have a
Yes.
thesis for holding,
Yes.
then you're going to toss and turn at night and feel upset and uncertain. And when it just does a little bit down, you're going to go, I'm out. And that's when you're
Yeah.
going to beat yourself up when it goes back up again.
Yeah. And the thesis for holding doesn't mean that does not mean, oh, I think my thesis is it's going to go up in 6 months. That's not a thesis. That's not a thesis. Like you want a fundamental thesis. Like, guess what? Based on its fundamentals and valuation, if I buy it now, I know it won't go bust. I know that it'll probably make X amount this year, next year, and maybe the next 5 years. Throw in a very bad scenario and then say, if you can live with this bad scenario, it's worth holding. You know.
What would be, I don't know, I mean, and you can say, I don't want to answer this question if you want to, and you want to move on to the next slide or something if you want, but
Mhm.
what would be the top couple of things that you look at when you value a company?
Oh, this is the difficult part, right? So that's why learning the financial markets, it's easy to get into, but it's difficult to master, right? So things like technical analysis is easier because you're just looking at price patterns. Things like basic fundamentals, looking at PE values, PV values, book values, right? And that's also easy because there are lots of services that throw out those numbers for you. But in the end of the day, to have when things are working well, right, it's okay to use all these things. But during the crisis environment where things are uncertain, that's when there's no shortcut. You have to understand the business model. That's the only way for you to have conviction to hold or not.
And where
You
do
know,
you
and
find that? Where do you look?
you have to learn the bit. I guess that's where I was happy for my time as an analyst. But where do you find the business model?
Yeah, I
Okay,
guess
there's no
so.
way out about this. You have to basically download the last three to 4 years of their annual reports, and you
Hmm.
have to read all of them. You have to read all of them because you can, in the annual report, right, they will tell you, you will learn about the company, what they sell, how they sell, and what affects them. And also and they will also report year to year what decisions they made that caused this to happen. So as you read all these things, you start to realize, oh, that's how they work. This is their risk. Historically they make X amount, and then from there you're able to make. Okay, so for example, I'll give you an example, right? Uh, and in a crisis, you have to put in the work. That's the thing. There's no shortcut to this. Okay, there's no shortcut because you have to work to overcome your fear. That's why you do a lot of work. So there was one company I was looking at recently, right? And something told me that this is a very good price, okay? And I need to know whether I should buy because buying small amounts is easy, but buying big amounts is difficult, right? So it was a natural gas midstream natural gas service provider, right? And so no choice. I actually downloaded like 5 years of their annual statements. I even opened my Excel spreadsheet. I had to key down like all the revenue for every year, all their balance sheets every year, their cash flow every year, and I had to account for why every year changed. Oh, okay, look, for example, this particular segment went up. Why? And they tell you why. Then that's how you really understand. Then you go, okay, I see how their cash flows change with all these reasons. Now, let me think about what's happening in the future. And then you're able to kind of estimate some sort of worst case scenario. And then you can go, I can live with that. The share price is so cheap. Even if their earnings drop by half, it's still worth more. You can make a statement like that. And once you can make a statement like that, that's when you can sleep at night. And
Okay.
that's when the price goes down, you won't be thinking of selling, you might be thinking of buying some more. But if you don't do this homework and the price goes down, you are always going to be thinking, oh no, this company is just hopeless, I'm going to sell it. Right?
Fair enough. Fair
Yeah.
enough.
And also, there's so
So,
many stocks in the market. Sorry, last piece of advice. There's so many stocks in the market. Okay. If you don't understand one stock, just move on to the next. You'd be surprised how some companies are very simple to understand. They don't have like financial derivatives on their books. They don't have multiple income streams. Sometimes they only have one or two, and they have no debt. Some are actually really simple to look at. So yeah, just move on if you can't find one.
yeah, that is one thing I have noticed is that there's so many companies and you can fall in love with all of them. The only problem is there's just too many to keep track of. How many do you normally keep track of on your portfolio at a time?
Okay, so the thing is, I keep track of all the ones in my portfolio, but I'm different. Okay, first of all, I'm not in the markets professionally anymore for now. So just want you guys to know that. But for my own portfolio, for my big positions, right, I keep track of all of them. So I make sure that every quarter when they release their results, I have to read through what happened. And if they give any sort of announcement, then I have to read that as well, just to make sure that my thesis is still intact.
Okay. Um,
Yep.
okay. So, okay. So basically, I guess the answer is you have as many in your portfolio as you can follow up on and keep track of.
Oh yeah. Also, so for the absolute number, sorry if you're asking me right now the number of stocks in my portfolio is like, I would say eight right now, maybe seven. Yeah.
Okay.
And so I'm of the okay. So I'm a bit different, right? Most portfolio managers will die when they hear that. They go, "What? That's not diversification." Like you need at
Yeah.
least 20 to 100 stocks. But I'm of the, I don't know whether it was Warren Buffett that said this, but he said something like, "I'd rather know like 10 stocks really really well than 100 stocks marginally well."
Uh-huh.
So I'm of that category. I rather know the companies that I own really really well. Yeah.
You know, it's amazing that you said eight, maybe seven, or seven, maybe eight, or something like that. Because
Yep.
yesterday, this was playing in my head. Yesterday, I was on a Zoom call with a, for want of a better description, a Bible study group. And the passage that somebody asked me to read on that, which was a part of the curriculum for the day, was Ecclesiastes 11. And now, Ecclesiastes is the book in the Bible that says everything's pointless. It doesn't matter. It's despondent. You know, he's had wealth, he's had riches, he's had women, he's had food, he's had work,
Yep.
he's had everything you could possibly want. And he just goes,
Yep.
everything's pointless. When you read it, you go, this is like depressing. But Ecclesiastes 11, the beginning says, this is the NIV version, says,
Yep.
invest in many ventures. I was like, okay. It says, ship your grain across the sea. After many days, you may receive a return. Invest in 7 ventures. Yes, in 8. You do not know what
What?
disaster may come upon the land. So
Are you
just
serious?
say, I'm serious. So, yeah. So, and then a little bit later, it says in Ecclesiastes 11, verse 6, sow your seed in the morning, and at evening let your hands not be idle, for you don't know which will succeed, whether this or that, or whether both will do equally well. So keep studying it, keep working it, keep different angles, keep different things, but invest in 7 ventures, yes, in 8. I mean, come on, man.
Hey, Solomon, right, is considered one of the legendary. I would say he's a legendary fund manager. People don't realize that. Like he grew his empire through basically trade, essentially, right? Coupled with wisdom God gave him, right? So actually, he has a lot of good ideas when it comes to life and wisdom, right? But you know what I read Solomon a lot actually, so that's really cool. At the end of, so just some tip, right? At the end of Ecclesiastes, right? You know, as you mentioned, he said everything is meaningless, right? And then all of a sudden, at the end of it, he says that at the end, he says this is the conclusion of the matter, that all the wisdom of all the wise men, right, are like goads that point us to the ultimate, and the ultimate is the shepherd with nails.
Mm-hmm.
All his machinations into what is life and wisdom ended up with a prophetic message about a shepherd with nails that only points to like one person in history, which is very interesting, right? But one thing one reason why I really love, or rather I'm intrigued by stock market bottoms, is actually because of what Solomon said in Proverbs 20:25. Actually, he said that something like this. Okay, it is the privilege of God to hide a matter. It is the glory of kings to seek it out. There is something about investigating the mystery about something that is hidden, right? That is not obvious, that brings about something in our human nature that's very kingly. So when I look at like stock market bottoms, that's the ultimate. It's the ultimate mystery because everyone's losing their heads. So how do you find the secret when everyone's losing their heads, right?
Yeah. But I guess what you said about reading the annual reports and really getting to know the company that you're interested in investing in fact, it brings to life that the first part of that Ecclesiastes 11, where it says, ship your grain across the sea. After many days, you may receive a return. Ship your grain across the sea. When you ship your grain across the sea, you put it on a ship and you send it somewhere. You know where it's going and you know what the deal is at the other end, but it still says after many days, you may receive a return.
Yes.
But presumably you don't go get your grain and you throw it in the sea and hopefully you get a return. You're shipping it to a particular point for a particular reason with a particular deal or thesis or transaction in mind. In other words, you know what boat you're putting it on, you know who's captaining the boat, you know where it's going and what the deal might be done, and you have an idea of the chances of it getting there, even in those stormy times. So there's an
Yeah,
element. The teaching for me is I need to read some of these annual reports rather than just go, they were trading at $120, now they're trading at 30. The probability is it's
yes.
going to go up something, so let's just wait.
No, you can't. Yeah, you can't do that. You can't do that because
Well, okay.
not in a crisis. You can't do that.
I'm
But that's
ashamed.
interesting. So Solomon was saying two things, right? He's saying diversify. That's why you have seven or eight. But you need to know that seven or eight. What's the point of those seven or eight, right? And
Yep.
not all might not work out, but hopefully most of them do,
Yep.
right? And yeah, I just
That's pretty cool.
and I just think it's. I mean, there's so much wisdom in the book of Proverbs and Ecclesiastes, right? But I'm just going to read out the last part of Ecclesiastes again, right? So it's so interesting, the conclusion of the matter. And he said in verse 11, chapter 12, verse 11, right at the end. And I remember when I was reading Ecclesiastes, I was like you. I was thinking, at the end of this, he says everything's meaningless. So why is he giving me all this good advice about investing, about how to honor your parents, about how to honor life, about this? Why is he giving me all the advice if finally he says everything's meaningless, right? And
Yep.
then I read, then I thought this was a joke, like the book of Ecclesiastes was a joke, you know. It's like you set me up for a bad ending. And then so verse 11 says this: the words of the wise are like goads meaning that it prods you in the right direction, right? They're collected sayings like firmly embedded nails given by one shepherd. So this guy is saying this, I'm the wisest guy around. I have experienced so much stuff, but I'm telling you in all my experience that if you collect all the wise sayings of everybody, because Solomon said that wisdom is because wisdom leads to life, right? It's for like a higher level of living in the world. That's why you do wisdom, right? And he's basically saying that if you took all the wisdom of the world that increases your level of life, it's the same as firmly embedded nails given by one shepherd, pointing to like Christ Jesus, who's going to be crucified like about 1,000 years later. And then verse 12 is interesting even. He even gives an absolute warning saying, be warned, my son, of anything in addition to them. I thought it was really amazing.
That is
He's
amazing.
saying that, okay, he said, if you don't know what to do in life, right, start here, basically. This is where all the wisdom comes about, and so anyway, for myself, Kwan Zombie, right? But, I'm married to my Christian faith. So I will say this. Can I give some advice for the Christian investor? Is that okay?
Please, yeah.
Okay, so if you're a Christian investor, right, let me just say this. The bottom of the market comes when there's a lot of fear. So don't forget, as a Christian, what God tells you to do. He says you should not have the spirit of fear, right? God did not give you a spirit of fear, but of sonship and of a sound mind. So every time when you are afraid because maybe you made a lot of mistakes in your investment journey, okay, and that's fine, everyone does. Just remember two things. When that happens in your group of fear and you don't know what to do, you have to retreat into your identity as God's son first. Know that everything you've done is forgiven and that God, right, he can make all things work out for you as a son. So retreat back into your sonship with God, and then have a sound mind. Start again. Do it well, learn your thesis, and then trust that God will help you through the journey of what I call restoration of whatever bad decisions that you made.
Yep. And I guess the other thing is he's also testing the heart between love for him and love of money,
Oh,
especially in the
yes.
stock markets.
Yes. There is nothing like a crisis to reveal that to you. And that's so important. And to those people that think that, and this is my journey, by the way, what you're talking about is what I was learning in 2009. Because 2009 is when I lost like 50% of my whole entire savings, right? And I went through the whole cycle of condemnation. Why did I do this? What am I doing in life? Et cetera, right? And when you start to realize then like who your master is it money or is it God, right? And when you start to realize, you know what, I'm just a steward of God's money. Money doesn't validate me, but I just need to make good decisions. And I'm not married to the wealth per se. I think that's an indication, right, that you're maturing as a Christian, and that you'd be surprised what God can do when you don't make
When you're on
money
the
as your
ropes.
primary goal. Sorry?
when you're on the ropes.
Not on the ropes, right? I mean, it's like Romans 8:28 says this, right? All things work together for the good of those who trust Him, right?
Yep.
And work according to His purpose. Now, this is a very powerful promise, right? Because it says all things work together. That means good things and bad things. God can take both the good and the bad things and make it work for your good. Now, if you think about that, I think that's kind of like, wow, even the bad decisions you made, He can turn it around somehow. And you've seen it in the lives of, say, Joseph, right? All the Old Testament heroes. They went through bad things. Some of them even made their own bad decisions, yet God took it and made it into their favor, right? But the key part to make sure you're on the correct side of this verse is for those that love Him and work according to His purpose. That means not your own idea of what it means to be a Christian. You know, some people say they're Christian, they attend church, but they're just doing it to, you know, kind of complete their lives. But Christianity is not about completing your own life. It is about putting God at the center and asking, what does God want to do in my life and in the world around me? If I want to be a part of that, even if it requires a bit of sacrifice, I want to be part of that. Now, when you do that, that's when you know that that verse has a foundation, right? All things work together for the good of those who trust Him and work according to His purpose. And I found that back in 2009, when I did that, when I said, you know what, God, I was living my own life, basically, right? I went to church and all that, but it's for my own glory. It's not for His glory. That's all wrong. But when that happened, actually, that's when all the wisdom came in for me to measure the stuff I needed to measure. And that's when I caught the bottom in 2009. So I can't even take credit. Like, I'm so smart, I found out myself. I found what I needed to find out, the data, accidentally. When I say accidentally, I mean, I didn't do it by my own, you know, by luck. I think God had shown me that.
Had a hand in
so,
it. You were looking in the right place, but he helped you look in the right place.
Yeah, you can stare at information and not right in the face and miss it.
Well,
God has to point it out to you.
I didn't see that the nails in the shepherd that you pointed out just now when we were studying Ecclesiastes. So I didn't see that. Yeah, that's interesting. It's funny. Anyway. Amazing journey. We could talk for hours, and I'm conscious that we have. So, but maybe we could do another one where we can go into, if people like it, if people like this one, where we can look at some other ways that you make decisions. So getting the annual report and reading it and understanding how they're thinking and stuff like that is one thing. But what about some of the trend lines and some of your ideas about that? Or because you kind of bring technical and fundamental and quantitative all together, and you sort of operate in that intersection, which is an interesting place to operate.
And no one cares about me because I'm not a master in any one of these things. No one cares about me until it's crisis.
Well, you're like Clark Kent, aren't you? I mean, Superman only comes out when there's a crisis. No, then he goes back to working in the Daily Planet.
I think I'm a bit more cuter than Clark, but sure, I'll take it.
Yeah, you're married, so that's fine.
I'm Asian, man. So, hey, can I just mention
my country and I'm in yours?
That's true. Hey, can I mention my website real quick?
Yeah, please do. So first of all, who do you want to go there? Who's it for?
Look, here's the thing, right? The website quantzombie.com. Initially, I was going to monetize it. This is 5 years ago, right? But then because I took a job in the US, so I couldn't monetize it anymore. So instead of just tossing the website away, I realized, hey, why not just use this as an information site, like a blog site? So quantzombie.com now is a blog site. And I'm basically posting my ideas and some webinars I'm doing for now, while we're in this crisis. Like, that's the whole purpose. It was for my friends, just so that they could know what I'm thinking about in this crisis. So I will say that, if you just want to get a bit more information about ideas while in this crisis, please just check out the blog on quantzombie.com. I mean, I don't know when this is going to air, but this weekend I'm having a free webinar again to teach a bit more and to give what I see in the market. And I think you attended, one of the webinars, or is it one or two?
Yep.
Oh, two.
Yep.
Oh, okay. So you've seen the webinar. So what did you think of the market updates? I mean, were they informative to you?
Yeah, they're very good. They're very good. Basically, in those webinars, you get to see how Kenneth thinks and analyzes something, and then he gives his rationale as to why something might move in a particular direction. But again, disclaimer, 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 and then make your own decisions as a result of
Yeah,
what he's
no,
thinking. So
yeah,
yeah,
no
yeah,
one cares about me. I mean, when you go on YouTube, you see like young technical analysts, giving, oh, this is how you should trade the bottom. This is how you should do this breakout. And they're like 1,000, like 100,000 views, right? And then you see
yeah,
like those fundamental guys, the old white guys that say, I've been in the market for 10 years. Let me tell you why the thing's going to collapse again. Who am I, right? But
yeah.
anyway, yeah. So I would say please check it out, because once this crisis is over, and when I feel that there's no like good money to be made, right, I will probably stop posting. So it's an opportune time now. So please, it's free. It's for my friends, right? So if you're joining, I assume you want to be my friend. So go to thequantzombie.com, go to the blog, sign up for the email thing. You see my ideas there, but you also see when I post like webinars that I want to do, you'll see it there as well. Yeah, so please do.
Nice. Very good. Excellent. Well, thank you, Kenneth. Thank you for sharing your ideas. Thank you for sharing with us about the psychology of the market. I've certainly experienced every one of those moments. Actually, if you go back and press pause on the video and just look at that chart that he put up with all the various things, I've lived through all of them. This one's been a real roller coaster for people because it's happened in such a compacted period of time, and then
Yep.
we're all thrown into isolation where we have to sit at home and ponder our disasters. But
Yep.
what would be great use of our time is to invest some of that in learning a little bit more. And I think you've helped people do that today, Kenneth. So thank you for your service to those people watching, and myself. So yeah,
Hey,
thanks a
thanks,
lot.
thanks, Tim. Hey, it was good. It was good. Thanks for having me on. It was just been fun.
Thanks again. And like Kenneth said, if you'd like to learn more, check out more, and see how he thinks and get to know him a little bit more, which means you want to be his friend and friends by friends lunches, then
Yes.
go to quantzombie.com and check it out, and I'll see you in there. But thanks for joining us. We'll see you next time. Bye.
Thanks.